Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
Today, Mike, I just found out statistically China's middle class is now larger than the U.S. middle class. Any shock there?
Well, there's so many people in China. It isn't a shocker. It's very interesting, though, to find that out. I always like to hear bits of information about China because in a lot of ways, you know, I live on the East Coast of the United States, on the other side of the world. China is a future global power. Its economy supposedly has actually surpassed the United States in size just a few years ago. But, you know, we hear all kinds of stories about what's going on over there. You know, in 2015, there are scares about the stock market in China has crashed, and there are all kinds of crazy stories and the talk that the economy there is a bubble, that weird things are happening. And I've actually know some people that have gone over there, they separately, they don't know each other, that they've gone on business trips and told me different things. And one of the things that both of them told me is that they see a rising middle class in China, just as you remarked on, but they also see turmoil that we don't know about, you know, isn't really reported, with workers and people going on strikes and some strife and so forth. In fact, one of them found out that lots of the factories in China, or the people running them, are now opening up factories in Vietnam and other parts of Asia. So it's kind of funny because I was watching the debate with Clinton and Trump the other night, and Trump talked a lot about China, how they're taking our jobs and they're doing these things, and attacked Clinton for that NAFTA deal, which she and her husband really pushed onto the country when he was president. But the funny thing is that it would seem that China now is losing its jobs to other countries that had gone over there from here.
OPEC has finally decided that it's going to cut production modestly, the first production cut agreement since 2008. However, they haven't said how much the cut will be, but just word of that again boosted the price of oil to above $48 a barrel. What do you think is going to happen with crude?
Well, that was an interesting news item this week. And immediately oil stocks went up. Exxon went up about 4% the day that was announced. But I looked at the details of the story, and essentially it was an agreement to come up with an agreement in November when OPEC meets. And the OPEC leaders basically said, okay, we're now going to get the people to work who are working for all of us to get together and try to come up with an agreement to cut it down, as you talked about, over 1.5 million barrels. And then they would officially announce that in November if they can come to a deal. So there actually isn't a done deal yet. And I don't really think oil, you know, it's helpful. I mean, you get a bounce from that news. Most likely oil prices will trade into that November meeting. Oil stocks could bounce into that meeting. If you look at what the oil stocks did, they pretty much just bounced off the lows. Many of them were making new 52-week lows into this week. So I just think it's a bounce within what still is a large bear market for oil and oil stocks. I don't think we're yet at the point where we're going to see sustainable rallies in oil. I mean, it can go up, like I said, for 6 weeks or whatever, but that's not going up for 6 months, which is what we saw in gold and the mining stocks this year. That's what a real bull market looks like when it starts. The gold stocks have gone up over 100% from where they were in January. That's what the GDX has done. And actually many of the smaller mining stocks have gone up multiples of that. And they're pausing now. They've gone down to close to their 150-day moving average. We've been in a correction since the middle of August. We're likely to come out of that sometime in October or early November and get another run higher. That's what you see in a bull market. You see dips to the moving averages that lead to new advances. In a bear market, you see bounces. And on the bounces, some news items that people latch on to on television land to hope that's the final turning point. But the thing about oil is inside the commercial futures market, which includes the big players such as Saudi Arabia and large production companies that are corporations in other countries and so forth, they're still heavily short. Now in 2014, before the oil bear market began, there's actually a record short position in the commercials futures market. It's still about half the size of what it was back then, but I would like to see that position get worked off to it hardly even exist. There's even a net long position before I'd get really bullish on oil and think it's going to do more than just rally for a couple of weeks. So that's where we are, and I think that means it's going to take more time, which is pretty incredible. I mean, it's been since 2014. We're speaking 2 years now, but the mining stocks, they dropped for 4 years basically. So these bear markets nowadays can go on for a long time, longer than people imagine.
Are there still opportunities to get into gold miners?
Oh, definitely. We've seen a dip that's played out over the past couple of weeks near support, the moving averages. People don't have positions. There's nothing wrong with averaging in right now to build one. I own in some individual small cap junior mining stocks, which tend to be more speculative, but I also have core positions in the mining stock ETFs and in gold itself. And those aren't positions I'm trying to trade or jump in and out of. And I think they're going to probably go up for a couple of years, because when you see the start of a new bull market, typically they last 3 to 5 years. And the turning point where you say, okay, we're starting a new bull market, the thing to indicate that is when you see charts with the 200-day moving average of a price, and the price is below that moving average for a long time, which with gold and the mining stocks is basically 4 years, and then a move up above that moving average, and then that moving average becomes support. So that's where we are. It's really the best thing, period, I think, at this point in time for people to invest and buy. Outside of that, you're really playing for short-term moves in the oil markets and other commodities for the time being. And when it comes to the stock market, and it's really difficult to make money because we've had the big run. We've basically gone nowhere for most of the year. I saw a statistic. People got very excited last month when the S&P 500 finally made a new high after about 3 years. It took that long for it to happen, and for the 36 months from the date of that new high, it was only up 10%. So it's kind of been a tough situation for investors in the stock market. People are getting used to making less and less money, more and more. My worry, though, is, when you get a market that's not going anywhere and it's just floating around above the long-term moving averages, that eventually you're going to tip below them, and people are going to start losing money, or at the very least, we'll get a correction. And I think that's what we're headed for. If you look at the S&P 500, it's got support now at 2120. We saw a quick, basically one-day drop a couple of weeks ago, a bounce off 2120. If we close below 2120, then I think we're going to be in a new downtrend for the U.S. stock market, in which case people should just be really patient and let that play out before they do any buying. I actually think people should have cash reserve positions that they make available so that they can buy later at cheaper levels. There's no way to get out at an exact top of any market or an individual stock on any sort of consistent basis. So at some point you just have to be willing to say, okay, this has done enough. The valuations are high enough. The price has gone up high enough. You know, I'm going to take some money off the table so I can have a cash reserve so I can buy things at cheaper levels later. And I think that's what everyone should have for the most part. Even that doesn't mean you should sell gold or gold stocks, but it's very difficult to be 100% invested in any one single thing. So I think people should reduce some of their gold, some of their holdings in the U.S. stock market and other global stock markets too, for that matter. The funny thing is the U.S. stock market has been just about the strongest market this year, while Europe and Germany, China, Japan have been weaker. Russia actually has been stronger than the U.S. stock market, but it's sort of taboo to suggest investing in Russia and the United States.
We'll have more with Mike Swanson right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mike Swanson. Mike, both gold and oil have seasonality connected to them. Is that something that you should be aware of before you make any investments in those sectors?
Yeah, and if you look at gold, for example, its seasonal pattern seems to be playing out. It tends to actually do very well from now until about the springtime, March, April. Those tend to be the best months, with a little bit of a correction in September. And that does seem to be how it's played out. Oil also tends to actually do something, actually kind of do the opposite, kind of dip into the end of the year and do better at the beginning of the year. Other commodities, too, as a whole, also tend to actually trade a little weak by the end of the fall and bottom out in January, February. I'm speaking of agriculture commodities, natural gas, just in general. But gold, ironically, tends to have its best months almost from now, this moment, onto the spring. So that, again, is another reason for people to really, I think, focus most of their energy at this point on gold, silver too, and the mining stocks.
The typical 4-year cycle for the stock markets, of course, has been extended by 2.5 years by all that quantitative easing. Do you think some people who took their investments off the table and went to cash 2 years ago are getting impatient?
Well, that's an interesting thing. I mean, when you say people, the statistics are that the average investor, the individual investor, has taken more money out of the stock market than they put into it starting around 2010, from 2009. After the crash, they started getting out. And then in around 2012, 13, they started to put a little bit more back in. But even then, since the past couple of years, they're taking more money out than they're putting into the market. But interestingly enough, so are foreign investors outside the United States. They're taking more money outside of the U.S. stock market than they're putting into it. Now, with the individual investor, there are many, many people that got out years ago and never got back in, and the NCDs, I'm speaking with people in America, and they're making nothing. They haven't made money. They're not likely to get back in now after all this time, and I don't really think they should at this point. But the thing is that there's a big question about all this then, is what's made the stock market go up if all these people are getting out, including people overseas. How in the world is the stock market going up? And the quantitative easing has been a part of that, but it's not where the actual buying has come from. It's enabled the buying. What happened was the Fed bought up the Treasury bond market and it made interest rates go zero for a government debt. That had the side effect of making corporate interest rates go down. The rate of interest on corporate debt and corporate junk bonds. That enabled companies to borrow money very cheaply, and they did that in an explosive way, in a record-breaking way, from 2012 up through this year. The corporations borrowed money like mad, and then so many of them simply used that money to buy back their own stock from the market. So that's where the bulk of the buying has come from. That's pushed the stock market up and kept it up over the past couple years, since 2012, really. Now, what's a little alarming about that is starting around August, news stories started to appear in the Chicago Tribune, in Bloomberg, some other financial media publications, although I don't think CNBC has reported on this yet, but Bloomberg has, and that is the fact that these buybacks have been pared back down to the level where before the boom in them in 2012, and that sets us up for troubling kind of limbo that we're in at the moment, where with that buying pressure gone, what fuel is there to make the stock market have another big run? I don't think it's there. All we've been seeing since August is some temporary drops in the market that bring in robot trading to buy on support, but that doesn't create sustainable rallies that last more than 2 or 3 days. You know, we just go back down to support and hope they buy, but that's what's been going on, with support now being the S&P 500 2120 level. But if you close below that, the robots won't buy until another lower support level comes. So that's the big picture why the stock market is trading the way it is. The volume hasn't come back into the market since the beginning of this month, since Labor Day, which I was expecting to happen, and usually does happen. Everyone I know is expecting to happen, but it hasn't happened. And when the market doesn't do things that it's supposed to do, that's a sign that things are different, things are changing, and I think that means the market is kind of got a little upside and a lot of risk right now.
The Bank of Japan is going to become the biggest shareholder in the 55 biggest companies in Japan because they keep snapping up shares. Is that a smart thing for a national bank to do?
I think it's a silly thing for them to do. It's not helping their economy at all. One of the things, though, that's interesting about the Bank of Japan is they had a meeting just 2 weeks ago, and that meeting followed a meeting in Europe. Now, two fascinating things happened at both these meetings. Both central banks said they can't increase their quantitative easing bond buying program. The reason why is because they're buying up so much government debt that there's none left for them to buy. So they can't increase their programs, which is absolutely amazing. Now, the Japanese bank, they want to do something new because people in the financial markets want them to do something. And they're running out of options. They got to come up with something. So the stock buying is something they've already been doing. That's nothing new. So they announced a new program, a little bit of a change to their quantitative easing operation. They said that in the future, they're prepared to stop trying to rig the long-term debt market, the 10-year bond or the 5-year bond or the 20-year bond, just forget about it and focus all their energy on an interest rate target on the short-term bonds. And if necessary, the implication would be buy any amount necessary to keep those rates on the short-term bonds as low as they want, basically zero or negative, and forget about the long-term rates. That's an explosive announcement that it hasn't impacted the markets yet, but the implications of that, if down the road that becomes their main activity, would mean actually a changing situation that would set the stage up for higher rates on the long-term end with zero rates or negative on the short term. That sets the stage up, or could in the future, for massive inflation in Japan, even though all the talk is deflation, and a monetization of their debt on a scale we've never seen before. We all talk about, or people in the financial media say, oh, the central banks are monetizing the debts, all of them. But that hasn't impacted inflation yet. But that type of policy, if the Bank of Japan does it and really implements it, will. And my fear is down the road, if we have another substantial stock market decline, a dip in the economy that has become so scary for people to even think about, it's almost become unthinkable. No one thinks the economy can go down and interest rates can go up. Donald Trump on Monday said the Fed can't raise interest rates or they'd crash the system. That's right. So at least that one statement he made's right. So what's the future monetary policy on the next downturn? If they can't do more quantitative easing programs right out of buying more and more bonds as they've been doing, they've got to make a change. I think in a year or 2 or 3, the central banks are going to follow the Bank of Japan and do this sort of thing where they just focus on the short-term rates and let the long-term rates go, and that will be a new era. That seems to be so far off in the distance. You turn on CNBC, they're talking about, oh, maybe they're going to raise rates in December, or the economy's going to pick up. They've been saying this kind of stuff for 5 years now, really. So if the markets decline, it's going to be a different monetary environment, and the Bank of Japan, I think, is the future of the world.
Mike, thank you so much for chatting with us.
Thank you. It's great to talk to you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.